The old model of venture investing has produced some horrible returns over the past 10 years, which has led a lot of people to say, what is it? Is venture investing over? Is it done? In some quarters, it probably seems to be, but some firms, such as New York's Union Square Ventures, are doing extremely well. And Roger, you say that in part this is because they really have a new approach to investing in venture capital.
No, that's right, Henry. Kind of what I coined it is kind of the ecosystem approach to investing, where historically venture firms have kind of wanted to own a deal and keep all the capacity for themselves and say they need to own 25% of a company in order for the deal to make sense for them. And that's really old school. What firms like Union Square has done, what I've done as an angel, and what a number of smaller firms in the New York area have done, is really take this approach of we want to build the best syndicate that can really help de-risk the early stage nature of these companies.
Syndicate of investors coming in.
Exactly. So instead of being so focused on I own 25% of the company or 20% of the company, it's better if I own 15% of the company, but I surround myself with strategic value-added investors who can really help mentor the company, make key business development relationships, and help nurture its growth.
And if you do that, I mean, it sounds great, right? You've got all sorts of different expertise. You're not just relying on a particular partner's brilliance or the founder's brilliance and so forth. But don't you get a too many cooks in the kitchen sort of thing, or you've spread out responsibility so much that nobody cares? It's just chump change investments for each person?
No, that's a great question. And I think the way that that's been mitigated to date is where there is a distinct lead. They're the ones that have the board representation, and they're the ones that are kind of the linchpin, if you will. They're the face to the board, but company CEO wants to reach out to somebody in a given sector, and one of their investors has that relationship, not necessarily the VC, then they go straight to them. And the investor's perspective isn't, I want control. It's simply, I want to help, and I want to maximize the value of my investment.
And in that model, does it change the kind of companies you invest in and what makes them successful, or do you still need a good idea and a great team at the company to execute?
Sure. Again, a very good question. I think it really subjects itself well in things like digital media, social media, advertising technology, where you're selling into specific customer bases where legacy relationships are incredibly valuable. If you're doing pure science, if you're doing clean tech or biotechnology, then clearly I would say that approach is less important.
Now, a broader question about venture capital, which is that part of what happened in the 1990s and the last 5 years leading up to now is the reason funds got so huge is because the partners can make that much more money, fees under management and so forth. So that creates the need to put these gobs of money to work in every deal and so forth. So it sounds like what you're doing is much smaller scale. It is smaller companies, they need less capital. Is this going to drive a lot of traditional venture firms out of business?
I think the answer is yes, is that the combination of enabling technology is getting much, much cheaper, and the fact that a lot of these business models require just less capital over their life, that yes, a lot of those firms that have kind of morphed into asset managers as opposed to being true venture investors are going to go by the wayside. Their LPs are going to say, we're done. But then those firms that still can deploy significant amounts of capital, but it's going to be longitudinally. It's going to be over the life of an investment. It's not going to be stuffing them with $10 million day one. It's going to be playing in the angel round, playing in the early stage, and then leading their A and building a bigger syndicate in their B. And some of those businesses, I mean, Zynga is a great example of a company that has required a lot of capital, but its returns have been phenomenal.
And last question quickly, the top tier firms like Kleiner and Sequoia, are they adapting to this model, or do they have the prestige where they can say, no, sorry, we are taking 25%?
I think there are a few firms that will be able to continue with the old ways. But just a few. And there are lots and lots of firms that raised funds in the hundreds of millions and low billions of dollars that do not have the Sequoia and the Kleiner legacy that are roadkill.
Thank you, Roger.
Thanks, Henry.